One of the most confusing parts of retirement taxes is something planners often refer to as the Social Security tax torpedo. It's a terrible nickname because it sounds like it's something that's going to sink your retirement income plan. In reality, though, it's simply a part of the tax code that can cause retirees to face unexpectedly high effective tax rates on the income they recognize for a period of time. What makes this confusing is that the tax brackets themselves haven't changed. What changes is how a portion of your Social Security benefit becomes taxable as other income increases. And because of that interaction, recognizing income while in the zone can sometimes cause more income to be taxable than people expect, which can lead to some surprises during tax time. This often shows up when retirees start taking withdrawals from retirement accounts, or when they're thinking about strategies like Roth conversions. In this video, I'm going to walk through exactly how this works using a simple example. And by the end, I think you'll see that the tax torpedo's bark is worse than its bite. Many people assume that their entire Social Security benefit is taxable. In reality, only a portion of the benefit may be included in taxable income, depending upon how much other income a retiree has. In some situations, none of the benefit is taxed. In others, up to 85% of the benefit can be included in taxable income. And that means at least 15% of the benefit is never included in taxable income under the federal tax calculation. And that's irrespective of how much other income there is. The calculation looks at what the IRS calls combined income. And that includes your other income, any tax-exempt interest, and a portion of your Social Security benefits. As that number rises through certain thresholds, more of the Social Security benefit becomes taxable. And that phase-in structure is what creates the tax torpedo. The easiest way to see how this works is with a simple example. Imagine Mary, who is single and receives $2,000 per month in Social Security benefits. That's $24,000 per year, and the tax calculation is based on the annual benefit, not the monthly payment. I'll say that again, because this is where most of the confusion starts. The tax calculation is based on Mary's $24,000 annual benefit, not her $2,000 monthly benefit. Mary also has some investment income. So let's say she receives $4,000 in dividends, $8,000 in taxable interest, and $5,000 in long-term capital gains. At that level of income, a portion of Mary's annual Social Security benefit becomes taxable. And in this example, $2,000 of Mary's $24,000 annual benefit is included in her taxable income. So that works out to about 8% of her annual benefit being included in her taxable income. Remember, that doesn't mean 8% of her benefit is the tax. It simply means that 8% of the benefit becomes part of the income that's subject to tax. Now, let's see what happens when Mary recognizes a little bit more income. Suppose Mary withdraws $1,000 from her IRA. You might expect that she simply pays tax on that $1,000. But because of how the Social Security formula works, something else happens at the same time. That withdrawal also causes an additional $500 of Mary's annual Social Security benefit to become taxable. So Mary's taxable income doesn't increase by $1,000, it increases by $1,500. The $1,000 withdrawal plus the $500 of Social Security that is now becoming taxable. Now let's assume that Mary happens to be in the 12% federal tax bracket. Because her taxable income increased by $1,500, the tax on that additional income would be 12% of $1,500. And that works out to be about $180 of taxes. But remember, Mary only withdrew $1,000 from her IRA. So on a $1,000 withdrawal, Mary ends up paying about $180 of tax, which works out to have an effective tax rate of roughly 18%. The tax bracket itself hasn't changed. What changed is that the withdrawal caused more of her Social Security benefit to become taxable at the same time. It's also important to understand that the torpedo doesn't last forever. It only occurs while combined income is within the IRS threshold ranges, where Social Security benefits are being pulled into taxable income. As combined income rises through those ranges, additional income can cause more of the Social Security benefit to become taxable at the same time. But once the calculation reaches the point where 85% of the benefit is already included in taxable income, the torpedo stops. At that point, additional income no longer causes more of the Social Security benefit to become taxable. The Social Security tax torpedo isn't a separate tax. It's simply the result of how different parts of the tax code interact. And despite the terrible nickname, I've never seen it sink someone's retirement plan. What it can do is create a surprise. When someone withdraws money from an account, they end up filing their taxes the following spring, and then they realize they owe more than what they'd expected. And that can feel like being blindsided if you don't understand why it happened. But once you understand how the interaction works, it usually becomes much less intimidating. In most cases, it simply means that a portion of your Social Security benefit became taxable because other income recognized during the year happened to make it so. It's not a penalty. It's not a trap, although it's often talked about as such. It's simply the way the tax code coordinates different sources of income. And when you understand that interaction, it becomes something that can be anticipated and planned for rather than feared. If this is something you're thinking about as you approach retirement, these are exactly the kinds of decisions I help people think through. If you'd like help thinking through your own retirement income strategy, you can schedule a conversation with me using the link below. If you're also thinking about Roth conversions, I have another video that walks through the most common Roth conversion mistakes people make as they approach retirement. And if you found this explanation helpful, consider subscribing. I share videos designed to help people make clearer decisions as they move toward retirement.